Welcome to a special episode of the Legal and General podcast. We talk to advisors about their opinions and views in the intermediary space. My name's Wayne.
And I'm Hazel, and today we are joined by Mark, who is Director at Viva Retirement Solutions. So thank you very much for joining us. Do you want to tell us a little bit about yourself and your business?
Yeah, so Mark Lambert, one of the directors at Viva Retirement Solutions, been in the equity release market for over 20 years now. So I was a tied advisor and a manager at a rival firm. And then 12 years ago, coming up to 12 years ago, we started Viva Retirement Solutions. And grown from strength to strength, really. So highly commended in our very first year at the Equity Release Awards, and then won our category every year since. So eagerly waiting. By the time this goes out, we'll know whether we've been shortlisted for the Later Life Lending Awards in 2025.
Everything crossed for you.
Fingers crossed.
Yeah, but you keep that run going for quite some time.
Exactly that. Yeah. So it's important to continually increase the benchmark. You know, it's we do a lot more with the industry. It's not just about writing business. It's about making the industry better for everybody. You know, working with the council, working with lenders, doing lots of things that aren't just about writing business and earning money. You know, it's about, you know, the greater good for everybody.
Definitely. I know, because you're quite heavily involved in the Equity Release Council, aren't you, working with them? So what does that involve? And you know, obviously you said it's important to be continuously up in that benchmark of what you do, but how does that then filter through to your firm and the clients that you're dealing with?
I think it's more of a time commitment and a knowledge commitment individually, you know, so both Paul and myself, as well as some of our advisors, are involved with the standards boards and the Equity Release Council work groups and things like that. Personally, from a Viva perspective, it's great to be able to use that knowledge for the benefit of everybody, you know, to try and, for instance, you know, the fifth standard for the first new standard for the Equity Release Council. My business partner, Paul, was very much behind that. So that's quite an accolade, really. Didn't do it single-handedly, but certainly was the driving force behind getting that through. So that kind of benefits everybody. Does it benefit us individually as a firm? Probably not. It's just good to be able to use that knowledge for, you know, we'll benefit from the better products and the better support or the better, you know, whatever the outcome might have been. But it's more about making sure that the market continues to move forward.
Yeah, and it's doing your piece, isn't it, for that market you're in? I guess the bigger
absolutely. You
can make that market, the more there is for you in the firm to look after.
Exactly that, yeah.
So why Equity Release? What is it that where did that passion come from? So
I kind of fell into Equity Release by accident, really. It was Nick Birdseye, so with Legal and General now, but he employed me as an advisor with Aviva.
Wow.
So prior to that, I'd done a couple of years as a financial advisor with Co-op Insurance, and I was an aircraft engineer beforehand. So I knew very little about the market when I sort of first came into it, but quite quickly realised that it's one of only a few products that can change people's lives immediately. So protection is great, you know, we all need protection, you know, but it's that peace of mind. But actually, for the vast majority of people, they'll hopefully outlive the protection policy and therefore never see the benefit of it other than having that peace of mind, which is absolutely needed. Whereas with the lifetime mortgage or just equity release in general, you know, all of the products that are available, it makes an immediate impact. It stops people choosing between heating and eating. It gives people the flexibility in their lives to be able to go on the holidays or visit family or you know, gifting. You know, we're doing a lot of gifting at the minute. So it's intergenerational wealth, you know, and able to bring them inheritances forward at a time when they're more needed. You know, so it makes a real impact to people's lives if done for the right people at the right time. And that's what's really important when you're giving advice on equity release, that it is for the right people at the right time. Because if it's done wrongly, it's very expensive. You know, it's about making sure that the right product has been selected for the client to enable them to achieve their objectives, but in the most cost efficient way. So it's the passion for me is that game changer in people's lives, utilizing that bricks and mortar that they've built up for many, many years to be able to then use that for other things.
I feel the passion. It makes anyone want to look at equity release, the way you've just described it there. And I've personally worked in equity release as well, so I've seen that. And I can always remember there was one gentleman that one of my team gave advice to, and he sent a little picture of him with his Bentley that he'd always dreamed of having. So you get what I love about it as well is you get all range. As you said, you've got some people that's between heating and eating and needing that equity as an emergency. You've then got some that it's their luxury purchases they've always wanted to do, but they've got equity in the home, they've got no dependents, so let's just spend this. And then so you've got those in the middle that actually it's a really right thing, right time, and then can enhance what they do. Yeah. You mentioned gifting and that kind of intergenerational wealth. Yeah. Are you seeing more of that? How has that changed?
Yeah, I think we're certainly seeing more of it. So the financial climate at the minute, the cost of living, historically the unemployment rates and things like that. There's a lot of older clients or older people. When we say older, we're over 55. So there's a lot of people fall into that bracket that don't feel old, but that have got all of this equity that they can actually use to help and support their family, whether that's upsizing, the family have had more children, they want a bigger house, whether that's to help with family businesses, whether that, it can be for a whole host of reasons, even just sometimes wanting to gift some money now so that way they can see the family enjoy it rather than having to wait until they've died, which might be another 10, 20, 30 years away. And by then the children, the beneficiaries of their estate are going to be retired themselves and they can make more use of it now. So there's lots of different reasons, as well as the tax implications, gifting for inheritance tax purposes and all that sort of stuff. So it's important, obviously it's done all with the right advice, but it's got such a broad use both for clients and for the beneficiaries of the gift.
Just bringing that tangible joy to their lives at that particular time, isn't it? To be able to benefit and see it themselves, as you've said.
Yeah, that's right. Yeah, and that's the immediacy of the product. So if for those that are gifting, it's not the client themselves. It's then the beneficiaries of that gift that are benefiting from the release for whatever that purpose might be. But it's usually a life-changing event. It can be significant money. If there's a lot of equity tied up in a property and the funds are needed, then it comes at a cost. There is the reduction in the legacy that they're going to leave, but providing the clients and their beneficiaries understand that, then it's a cost that's been considered, that's weighed into the numbers.
And how is that received by clients at the moment conceptually with the way the wider economy is and stuff like that? How are they receiving the concept of it? Is it something that's more of a slow burn with clients they have to think about more, or are they more akin to it? How is it at the moment?
I think it's always a much slower burn than other products. Yeah. And so it should be. There's a lot of considerations to make. Whilst the risks to a client are quite minimal, the risk of repossession, for instance, not too dissimilar to a conventional mortgage, with the big difference that there's no mandatory payments to make. So if you think about why people get repossessed on a conventional mortgage, it's because they've fallen behind on their payments and got into arrears and just got themselves in a bit of a pickle. Whereas you can remove that whole aspect of it for lifetime mortgages. So it's such a flexible way of borrowing money, with drawdown facilities and being able to really dovetail it with benefits and with the right advice. It's really it's a product that I can't compare to any other in the way that it's grown over the years.
Yeah, and I think it's one of those as well. There will never not be a need for it because, as you said, it's people are at the moment getting older when they purchase their first time homes. There's potentially less ability for them to save than ever before. And, certainly in our Bank of Family research, that is something that we've seen. Bank of Family is one of the biggest growing lenders, isn't it, in the UK? Yeah. And yet sometimes customers will still think, equity release, that's got bad connotations, or it's the lender last resort. Yeah. How do you reassure if you've got clients in front of you, or if you're doing any sort of marketing for your firm, what do you think is the biggest reassurance?
The first thing we do is don't call it equity release. It carries too much baggage from plans that were sold 40 years ago. The late 80s, early 90s, home income plans, shared appreciation mortgages. They were very much at the time designed for the lender, not the customer, pre-regulation and things like that. So we start by not calling it an equity release plan. We talk about lifetime mortgages. We talk about retirement interest only mortgages, and by using the phrase mortgage, it's something that's very familiar with them. It's reassuring. It's not new. Somebody down at the pub isn't saying, "Oh, you don't want to be doing one of these lifetime mortgages." They're saying you don't want to be doing one of these equity release plans from a completely uneducated position. Quite often, when you speak with a client, they'll give you the scenario, you'll give them a solution which might be a lifetime mortgage, and you'll explain how that might work, and they'll say that all sounds really good, almost too good to be true, but I don't want one of them equity release plans. So I think we're at a stage, my own opinion, I've had it for some time, is that we need to almost as an industry move away from the term equity release.
How do you approach that? Just quickly, whilst we're on the point, I don't want one of those equity release plans. But it's more about saying, well, what do you mean by equity release? Yeah. Because you could sell and downsize, you've released equity. You could take out a conventional mortgage, and release equity. There's lots of ways of releasing equity. So I often personally liken it to the umbrella name. So you've got a savings account, right? Okay, what type of savings account is that? Is that a cash ISA? Is that an instant access? Is that, and there's lots of different types of savings accounts. Well, there's lots of different ways of releasing equity. The lifetime mortgage is one of them. So it's about kind of making the client step back a little bit from what they perceive as equity release, and then focus on what I'm describing as the lifetime mortgage. Because they'll say in the same breath, that sounds too good to be true, but I don't want equity release. So the mindset of the client is very much listening to the bad press that it's had over the years, and rightly so. Some of the plans wasn't great, with very restrictive terms to them. Thankfully in years well before I got involved in the industry. So it's encouraging the client to think about what equity release actually means to them, and then comparing that to what the modern plan looks like. And then sometimes it's about just educating, just like I've said now, about the history of where these plans have come from. You can date equity release plans back to the 60s, look completely different to what they look like even in the 80s, which is what we hear all the bad news about. But they've been around a long time. And the market is only getting bigger, So yes, we've hit a few bumps in the road over recent years. I think we'll still be doing over £2 billion this year of lending. So that's £2 billion that's not only changed people's lives, but that's back into the economy in one shape or another. So the wider implications of it are huge. So it's, to answer your question, make the client really understand what it is they perceive as equity release, and then make the comparisons to the modern plan. Because they'll usually have some fixed idea about you can't make payments, you'll lose your house, you'll this and that and the other, and it's like, right, okay, well, let's look at the numbers, let's look at, and it's education.
And I guess it's not just with clients either, isn't it? It's professional connections.
Absolutely. Because
even, in the wealth, there might be people listening to this in the wealth space that are like, well, my job as a wealth advisor is to rid debt, and they'll maybe be used to those, horror stories from the 80s and be thinking, no, I've never maybe not looked at equity release, or as we said, later life lending since then. So they also might have a quite a negative connotation of what that means.
Absolutely.
Do you get quite a lot of referrals from wider connections? How does that work?
Yeah, so about 2/3 of our business is from referrals. And that's intentional. When we started the company, we made the intention of building our business on predominantly referrals. Because when you're going back to the sort of earlier point, when you're speaking with one client and educating one client, they might tell somebody else at the pub, and you've spoken with two people, one directly and one through word of mouth. If you educate introducers, be that wealth advisors or mortgage brokers or solicitors or estate agents, then if you educate them well enough, they're speaking with 50 or 100 people about it. So it's a much quicker way of trying to educate the country in what these plans actually look like now. Nobody questions a regular mortgage. We all know what they are. We all know that there's risks of repossession, but nobody goes into buying the house going, oh, I'm a bit worried about this mortgage because I might get repossessed, because they know that if they make the payments, they won't. So and I think that's where we need to get to with this market, with the plans that we have now and plans that will come in the future. It's about making them just socially acceptable, getting rid of the baggage of the past, making sure we educate enough people now that they know that these plans exist. Because sadly, there'll be people, as there is every year, that don't know these plans exist, that own the house, that might have a substantial amount of equity in the house, and yet sit there with blankets over their laps, warming up a tin of beans in the microwave. It's kind of like they don't need to make them choices.
It's as stark as that, isn't it?
It
comes down to that.
Yeah.
And the impact that you can have on those types of people's lifestyle and how they live, and everyone, all the examples you've given earlier about those with a gifting scenario and that, it must feel great to be able to do that when people realise. I mean, some of the reactions you must have been so profound.
Yeah, absolutely. I think our testimonials on Vouched for instance, will vouch for that. It's the clients when they know that they've received the right advice, when they know that they've everything's been considered, so the benefit entitlements and just the long-term costs and the risks. When they go into a lifetime mortgage with their eyes wide open, then the benefits far outweigh any of the negatives, because they've made that conscious decision to do what they're going to do. So then whatever that reason might be, especially if it's kind of the client in need, the heating or eating scenario, then it's a game changer for them.
And they have concerns, don't they? You mentioned the benefit side. There is that element to it, particularly if they've got eligibility or whatever that time. They're going to be concerned about that going away. And I suppose you have to be a wider educator in that piece. You have to know your stuff, don't you?
Yeah, that's it. Yeah. It's not just benefits. There's a whole raft of, it might be long-term care funding. It might be inheritance tax. And it's not that we're authorised or even educated enough to be able to give advice on them things, but we need to understand them well enough to be able to know when our advice is going to impact on them things. And that's when we call in our other professionals, so it might be benefits or it might be inheritance tax. And that's when we'll use our network of connections to say, right, this is the client situation. Let's work together to get the best solution. Because the last thing you want to do is, just to use benefits as an easy example, release a load of money for a client for all of a sudden to lose all of the benefit entitlement. It's a double whammy in terms of the cost. Not only they've got the cost of the lifetime mortgage, but now they're using that to replace the income that they could have still been getting. And with the modern plans, with drawdown facilities and think, you can get the two to dovetail together really well. To make sure that they can maximise benefits that they're entitled to. I'm a big believer that if somebody's entitled to benefits, they should claim them. Quite often we'll come across clients that are very proud. I've never claimed benefits in my life. I don't intend to start doing it now. My answer to that is we have a national insurance policy. It's, we pay national insurance premiums. You've paid into a policy to be able to benefit from it when you need it, when you're entitled to it. So claim it. If your policy was with Legal and General, you wouldn't think twice about claiming it. It's just a policy with the government, so claim on it. Claim on that first, and then let's work with the lifetime mortgage and the rules that we have within the plans to make sure that you maximise whatever that situation might be.
So generically, that's where you're coming into your own. You're looking at the generic advice piece, that fact-finding piece, to look at those areas where they might have benefit entitlement and stuff.
Yep.
Bringing in experts where needed, as you said. In that fact-finding mode, before you're bringing in any other solutions, you're looking at that first.
Yes. Oh, absolutely. Yeah. So once we've completed a fact find with our clients, then it's going back to the desk and really taking a step back and saying, right, okay, this is where they are now. This is what they're trying to achieve. What's the best way of getting there? And it's not just looking at a product in isolation and going, right, okay, well, the lifetime mortgage will do that. It's about making sure you've really considered all of the other options. And that's not to say that a lifetime mortgage is the option of last resort, because there's plenty of, that would often strikes the connotation of it's kind of those in real need. but there's plenty of wealthy people doing lifetime mortgages. So it's about making sure that it's just done for the right people at the right time. Something at Viva is we kind of, and I'm sure there's other advisors that do the same thing, but we often get the advisors to consider if that client's situation was your mum or dad or your gran or granddad, what advice would you give to them? Would you be telling them just to go and jump straight in to do a lifetime mortgage, or would you be suggesting doing other things first? Because there's very few people out there that would give the mum and dad the wrong advice, as best as they see it. So if you always look at it like it's your mum and dad or your gran and granddad, then you're never going to go far wrong. Your conscience is always going to be clear that you've never compromised the advice for a sale. There's enough business out there. If it's not right for a client, tell them it's not right for a client. Because if it's not right now, it probably will be in the future, which is why they've inquired, but you've just given them a path to get there. So spend your savings first. When that runs out, I've looked at your house. There doesn't seem to be any problems with it, so then let's use it in 5 years' time when your savings have run out. So it's about empowering the client to go, now I understand it, I can use it in the future, and it gives me the freedom to spend my savings, for instance. I
think that's really important. It's what I'm hearing here is it's not just a transactional conversation. Correct. You're considering the family, you're considering savings. And I think that provides a lot of comfort to those who are dealing with clients who maybe haven't sought to add equity release or later life lending into their network of professional connections. And I think that would definitely open up the mind to think, actually, if I've got a mortgage client that I'm dealing with, first time buyer who's not quite met affordability, well, actually, could their parents help out? Not only is the mortgage advisor then winning, the client's winning, the parents are maybe, as you said, getting that satisfaction of gifting early. I'm also thinking of it from a kind of wealth point of view. And you've mentioned care. Care is extortionate. We said in one of our previous episodes this morning, about one of the advisors saying his clients spend about £2,000 a week on care home costs. And you just think, actually, how much equity could they have had in their home that they could have used, or potentially put in, used the equity release, bought an annuity to fund all of that.
Absolutely,
But it is about advisors as well educating themselves on these benefits, and actually how in depth you will also go into to make sure it's the right thing. Yeah,
and how broad the product is as well. A common question from introducers, regardless of whether we've told them before or not, it always seems to get forgotten, is that a lifetime mortgage could be used with a purchase. So it's not just about releasing equity from the existing property. They can use it to help fund that purchase. So a common example is a client in the family house that they brought the children up in, a 3-bed semi or something. And they want to stay in the area because that's where their social network is. They don't want to move from Kent to Lincolnshire. They're moving away from everything that they know, especially in the golden years. But they want to move to a bungalow. Now, bungalows, traditionally in the same areas where they want to live, will be more expensive than the house that they're in. They sit on bigger plots, they're spread out over more land. And quite often, without any savings in place to be able to achieve that, then they can use the lifetime mortgage to help them get in the property that they want to be in. And with modern plans as well, the ability to make voluntary payments or interest service plans and fixed rates of interest for life. And they've got so much flexibility within these plans that they can make it work however they want. They can either make no payments at all, or they can make £50 a month, or whatever works for the client is what's almost beautiful about the product. It's lost its rigidity of 20 years ago when I started, where it's like you couldn't make payments, interest rates were sometimes even variable, linked to RPI, and then whereas now there's so much more peace of mind for the client, so much more control for the client, that it enables them to move into these bungalows. So yeah, it's the list is too long almost of what you can use these plans for.
It's interesting that you've mentioned the purchase, because I know there's a scenario, one of my friends' parents, they own a property with land, and they were looking at IHT planning, etc. But one of the goals they had, they did not want to move from this property. They absolutely love it. It's close to one set of grandkids, but their other set of grandkids are miles and miles and miles away. So they wanted a property, kind of a smaller property there, so they could balance their time between two homes to see the two lots of grandkids.
Yep.
And it was really interesting. It took them probably about 6 months to be convinced to actually look down the route of releasing equity to be able to do that. But now they absolutely adore it. They've not got any payments on it.
Yep.
They, financial advice dependent. They've reduced their IHT, liabilities, and actually now get to see both sets of grandkids on a weekly basis.
It's the journey they go through, isn't it? Because they don't necessarily understand or know about the products. They need to go and be educated and go through that proper process that can take a while, as you said, rightly so, as it should do. On the back of that, I suppose because of the imbalance in knowledge of the product with as an advisor and the client potentially, a lot of the clients are potentially vulnerable, aren't they, for that reason? So I'm interested, how do you deal with that? How do you approach that with clients, particularly new ones to the products or the way of?
Yeah. So, I mean, I don't think you can beat face to face. We do a lot of our calls over the telephone, but for any client that's really struggling with understanding, for any client that's clearly vulnerable, I think our demographic of client will have a higher percentage of vulnerable clients than the kind of national average. So anybody that sort of sits in that camp that needs that extra reassurance, and it's not reassurance to push them into a product, it's just making sure that they've got the information to make an informed decision, but they need to understand that information. If they're not understanding it, then we'll absolutely make sure that an advisor sat on the couch drinking a cup of tea, explaining it to them with no pressure, no obligation, walking away and saying, right, now you've got the information, have a think about it, whether family's been there or not. We'd encourage family to be there because family see it from a different aspect. Family see it as the receiver of the legacy. Family see, they might be more educated in finance. They might be, there's lots of different aspects you can bring by including a different generation there. So, to have family there is great. If they're not, then that's the client's choice. Or it's impractical, in which case we can set up Zoom calls or we can do telephone calls or we can, there's lots of ways around it. We don't have to exclude family just because they don't live 5 minutes away. But yeah, once you've empowered the client with the information, the factual information, not the guy down the pub that says, oh yeah, you'll lose your house, then it enables them to have the conversations with the wider family. And then they can pick up the phone and say, everything you spoke about, let's go ahead with, or actually for whatever reason, we've decided against it, and that's absolutely fine. It's got to not just be right from an advice point of view. It's got to be right from a client's point of view as well, because there's two things that make a decision: your head and your heart. The head might be absolutely it's the right thing to do, but my heart says I just don't want to do it. Leaving that legacy from the property, which kind of gets ring fenced in people's lives. If people have got savings, they don't think twice about spending it. They don't think, well, this is the legacy I want to leave to my children, but the property gets viewed very differently. So that tends to be a much more emotional decision. For those that have got that reservation about whether they should do it or not, that's where it usually comes from. It's the impact to the legacy. So if you've educated them properly, given them the information, at least the head decision is in the right place, and then it just becomes a heart decision. Then and then it usually boils down to the compromise between what the needs are, how desperate them needs are, and the cost of doing so. And
I'm hearing you're close to them all the way. That's the key. And as the advent of the pandemic, where you can bring other family members in because they may not live locally,
correct?
Yeah, on Zoom and stuff and Teams, has that really helped with that process, making sure that everyone's as engaged as they can be and need to be? It
has, yeah, absolutely. I think with COVID and everybody being isolated, I think it forced the older clients, the clients in the 80s and beyond, to become more tech savvy. Everybody was Zooming, everybody was doing some form of FaceTime. And I think that has opened the door to be able to have these conversations much better. If I think back to 10 years ago, Zoom didn't even exist, I don't think. It's kind of like, it's quite a new thing, and certainly propelled by COVID. So, and that's been great, really, because it means that we can have these conversations instead of sat with a cup of tea in their living room, and we can be sat with a cup of tea in our offices, but still having that same family conversation with everybody involved. And sometimes that's even, the other side of the world. We've had it with people zooming in from Australia and all sorts of things, that we just wouldn't have been able to do effectively 10 years ago. So they would have been very much relying on a phone call or an email or, without the client involved. And then it kind of leaves things a little bit disjointed. So the advent of COVID has actually been a really good thing, because it's forced people that was very technically challenged in IT, because they've never had to use it, let's be honest. It forced them into at least doing something, which now has opened the door to us being able to really have more inclusive conversations when the family aren't nearby.
Excellent.
Yeah, that's excellent. And I think it's amazing that you've done some in Australia. Like, as I said, like having the family brought in, I think that's incredible. And I think it's goes back to that trust element, doesn't it? Because if your client was really laying the information, I guess the family might think, oh, is this some salesperson? Or if you're calling the, child, family member direct, again, without their parents or loved ones' involvement, saying we chose to come and see this person, we trust them. Yeah. It's then really hard as an advisor, isn't it, to kind of instill that credibility and trust, having to do it in two separate conversations all of the time, and think that then out with your conversation, have both clients understood it well enough to relay it to each other back and forward the correct way, isn't it?
Yeah. So, and it's important that, once you've had them conversations, that they can discuss it between themselves when you're not there, because there will always be things that they don't want to say in front of their advisor. But as soon as that call finishes or whatever, or as soon as you've left the house, that's what they'll be talking about. And that's absolutely fine. That's part of the decision making. It's to challenge the product and whether they feel it's a fit for their needs. It doesn't matter what the advisor says, because they're the ones that ultimately make the decisions. So to make sure that everybody's in the same call at the same time means that they're getting the same information described in exactly the same way. So that way they can discuss it afterwards, rather than one thing being said to one party and another thing being said to another party, which both might be exactly the same, but said in such different ways, because you're speaking with a different generation or a different level of knowledge, that when they speak together, it actually doesn't sound like we've said the same thing. So then, that can lead to confusion and questions. And questions is great. There's nothing better than doing a fact find, explaining the fundamentals of how a plan might work, but I'm going to be looking to see whether it's the right plan for you and so on. And then starting the presentation with, before we start, do you have any questions? And there's nothing better than a list of questions, because it means they've given it consideration, they've thought about it, they've taken the time there to sit there and write these questions out, which I would have encouraged them to be doing at the end of the first call. It kind of unsettles me a little bit when you get to the second appointment and it's like, no, we've got no questions. What? None whatsoever? There's not a single thing, have I explained it that well that you now understand everything about it? It always makes me a little bit nervous. I much prefer 15, 20 questions than no questions at all, because then that they've given it the consideration that it needs.
Well, you're trying to verify that understanding, aren't you? And check that they've received the messages and the information in the way that you wanted it to be received.
Yeah. And that's where the client without any questions, you'd be challenging them a lot more about, you'd be asking much more open questions about their understanding of something, So we spoke about compound interest last time. Can you remember what that means? And let them relay it back to you to get that understanding. Whereas the client with the 15 questions, that may well have been one of them. Can you explain that to me again? I don't really understand what that means. It's just, you've got to approach the client in a way that suits the client, and no two clients are different. No two clients are the same. They're all different. They all have their own drivers, their own thoughts, their own circumstances, and that's what's interesting about the job. It can be quite Groundhog Day. It's a similar product set across all of the lenders, looking at similar situations, but everyone is different. Everyone, it's sometimes subtly, sometimes vastly, but everyone is different, and every one of them, it will change their life in some way, even if it just pays off their existing mortgage to keep them in the house because the mortgage term has come to an end, or they can't afford to remortgage it and they don't want to go onto the SVR at 8.5% or whatever it might be at the time. And they've got no affordability anymore. They've retired. So there's always a positive outcome. Which
is what gets you out of bed in the morning. I can tell by your passion.
Absolutely.
Does, isn't it? All the stuff you're doing, all that research you're doing with all the different providers, like you say, some of the products are similar, but that is the thing, isn't it?
Yeah. And that's kind of what I said right at the beginning. It changes people's lives today. So 2-3 months from application to completion, and that's the game changer there. You see it, you can speak to them about it. You're not waiting for a future event. You're not putting money into a pension for 30 years time when they retire. You're not putting a protection policy in place for them. When one of them's died, it's like, well, the good news is you had some protection. It's kind of like, it's a life changer today. So that's what's really great about it. It keeps you motivated. It keeps you focused on changing the next person's life.
It's a life changer today.
Yeah, it's amazing.
Wow, what a way to think about them.
So if anyone listening to this, then I'm thinking if we've got any, mortgage advisors, wealth advisors listening in, and they're thinking, right, I love what I've heard today. Actually, I do want to start thinking about how do I send referrals in to someone like Viva Retirement Solutions. Where would they start? What would you want, or if someone referring into you, how far would they need to take it? What would you need from them?
I mean, the reality is they don't need very much at all. Sometimes a referral might be just a name and a number. We've had somebody come into our office asking for equity release. We know nothing more than their name and number. Can you give them a call? And it might be that a lifetime mortgage or other later life lending plan isn't appropriate for them anyway, but we always start from the beginning. Whether and other referrals will be like, here's a fact find I've done with them. And it's like, well, that's great, but we're going to start again. We want to make sure that the advice we're giving, we're basing it on the information we've gathered from the client. So it's really important that, the more information we get, the better, because it makes that referral much more joined up, much more seamless. We can cross-reference and check the information rather than sort of putting the client to the trouble of going through this 90-minute fact find and things. But it's more, certainly at Viva, it's more about let us speak with the client, let us have that conversation, let us do a fact find if we get as far as that, let us do a presentation if we do as far as that. We'll obviously, certainly at Viva, we'll keep the introducer informed all the way through. This is what we've done, this is where we're at, this is what we're doing now. But it's not about the information we get from the advisor about the client. What's more important is that we've educated the introducing advisor in whatever capacity about the opportunities that are out there, because we'll have 1,000 conversations. Let's get the people to speak to first. Yeah. So it's, and this is exactly the same when we're referring out of our scope of advice. It's kind of like, here's some information that we know. This is why I'm passing them to you for inheritance tax or long-term care or whatever it might be. But it's now over to you because that's your area of expertise. So they don't have to be the expert. They just need to know enough to know if this might be right for this type of client. Let's get them speaking with Viva Retirement Solutions.
And that's hugely reassuring, because I think in the financial advice space, there are so many things to try and be expert in. And I think being able to have that reassurance and trust that there's another expert out there, you can focus on the bit you're good at. Correct. And trust your professional network will pick up the other parts. I think that's really, for me, I think that's an amazing community we're part of, that we can do that.
And I think that's where the market over the last 25 years or so has been an advisor now. The market has moved a couple of times, actually. It's kind of like, everybody should be holistic, whole of market on everything. And it's kind of like, how can you be it's that jack of all trades, master of none. I'd sooner be a master of later life lending, but no masters of other skills. Just the same as if you was having an extension built in your house. you'd get your plasterer, you'd get your builder, you'd get your electrician, your plumber. If somebody came in and said, I can do everything, is it going to be up to the same standard as what a plumber would be doing? Because it's their bread and butter. It's what they know best. And just like in the building trade, there are people that can do it all and really well, just the same as in our industry. But to keep abreast of all of the regulatory changes and the product changes across everything is a job in itself. We have a budget and there's new tax regimes. We have pension simplifications and pension freedoms. And, there's so many big changes that I believe it's much better to be a specialist at one thing, but know and understand enough when you go, actually, this is somebody else's conversation now, and let them take over that conversation for that aspect of the advice.
Well, even in the later life space, one thing I can always remember from being part of that world is it's the property criteria. It's so strict, isn't it, sometimes? It's having that knowledge of, well, which lender would actually accept this teeny tiny little element of this property, because they can be quite tricky.
That can certainly be the challenge. Yeah, absolutely. And the underwriters of later life mortgages, or specifically lifetime mortgages, the underwriting criteria is far more restrictive than the conventional mortgage market. So there's, and I understand the risks of doing that. You're doing a 20 or 30 year plan when the regular mortgage is probably rebroke in 2 or 3 years' time, when the fixed deal comes to an end and they'll be on somebody else's books, and it all just kind of moves around, and eventually they'll be mortgage free anyway. Whereas with the lifetime mortgage, that, there's a high percentage will be having that mortgage for life. So yeah, that can be the tricky thing, and that's knowing the lenders, the criterias, the BDMs at each of them lenders that are all really useful, and a good BDM is worth their weight in gold, because they know their product. Again, they're the master of their product. So that's where we, as masters of advice, use the masters of the product to say, right, okay, does this meet your criteria? And then you can hopefully find a lender that will accept whatever the quirkiness about it might be.
Yeah, well, as someone who runs a BDM team, I'm really happy to hear that. But I think it's definitely right. I mean, I think BDMs of any provider or lender go through such extensive training, and they're getting asked the questions all day, every day from from your peers in industry. So it's quite often that if they've been asked the question once, they're going to get asked it again and again and again, and have already looked at that solution and found a way around it. And if not, it allows us as a provider, when we get that feedback and get these questions, we can look at trends and think, hang on a minute, is there something as a provider lens we need to be changing here? So I absolutely advocate that. The more that BDMs are used and utilised, the more we can actually, in my opinion, adapt the industry and product ranges and propositions that we all have.
Piece is huge, isn't it?
Yeah. The BDM is like the funnel almost, isn't it? The advisor community all funnels it into the BDM, and they're kind of answering the questions, but consciously or subconsciously collating all that and going, that's the 5th inquiry I've had this week about whatever that might be. And that's when, that can then get fed back up the chain to the people that write the criteria and things. It's like, is there anything we can do with this and be able to help more people? Because there's nothing worse than having a real client in need, because, it's fine. It's fine if it's kind of, we just want money to enhance our lives, and they can't get it because of the property criteria. I say it's fine, it's never fine, I suppose, but it's a completely different thing when it's a client in real need. When they're facing repossession, when the heating or eating scenario, and then there's something what we would all deem to be quite small, that precludes them from eligibility across all lenders sometimes. So you're going back with a I'm really sorry, but there's nothing we can do to help because you've got an electricity pole 57 meters away. So there's lots of scenarios where it would be nice to be able to just accept every property, because no property is worth nothing. So every property has a value. It just might not be at the value because of the electricity pole, because of the pub 3 doors down. It's still going to have a value. So let's just release money based on its perceived value rather than actual value, because that would still give some people an option. So I think there's a lot of places that the market, and by the market, the lenders, en masse can look and be very much more pragmatic about looking at some of these properties and actually really saying, is there a risk to us? It's £1 million property, you only want £30,000 and we're declining it because of X, Y, or Z.
I guess that's where advice comes into its own, doesn't it? And actually why, as you say, going back to your point, it's really good to be the master of one trade, because actually you'll know the BDM you can speak to about that. You'll know which lender's more likely to be able to look at those things versus the ones that are a hard no, we're not, we can't do anything. And that'll flex with lenders, lenders' risks and what we can do from risk criteria as well.
All the time,
And that client who is really in need, you'll be much more likely to be able to find a solution for them than maybe someone that's going across doing everything, because you know that market so well. And as Hazel said, you know who to go to.
Yeah. And I mean, I think I would agree. What kind of counters that a little bit is that it's quite a small market. There are only 11 lenders for lifetime mortgages. So, but it's just, sometimes it's the speed, so that, the one that's holistic and maybe doing only a few cases a year and things, it's going to take them a lot longer to collate all of that information because they won't have the BDM contacts. They'll have to go to each lender individually, whereas a specialist firm would go, you know what, there's no point even going there or there or there because I know that they don't accept it. And it just speeds up the whole process. And we know what questions to ask. We know what might be a problem. We can look on Google Earth, before we even go to the house and go, right, okay, this is going to be a problem. There's a rail line that runs at the back of it. Let's how busy is that rail line? What questions are the lenders going to ask? So we can do all of that even before we've spoken with the client. It's like once we've got a postcode, we can do a lot of work to see which lenders are going to be. Whereas if it's a less experienced advisor, and we're seeing it now within Viva, we've just taken on 2 new advisors that have they've never advised before in any capacity. So they're kind of. I was only saying to my business partner Paul the other day how much you take for granted that you actually know, because when they're doing the sourcing and things like that, it's kind of like, well, no, you can't use that and you can't do that, and it's like, I just know all of this. You can't write it down. You can't put it in a manual because it just changes all the time. But it's you take for granted what you know. So yeah, that's the big difference. I'm a big advocate of being a specialist, a master of a sector, and let other people be a master of theirs.
Yeah, it's funny when you say the property bits, because my in-laws, they live on a country lane that they share with the Muller dairy factory. Okay. So it's down a country lane. They've got a silo tank. They've got more than a few acres of land. It's a nightmare that you wouldn't be able to ever, really look for a later life lending point of view. Yeah. And they suggested not long ago, we might look at some later life lending. And even though I'm not advised in years on that, in the back of my head, I thought, that would be that you need to go to a specialist advisor for that one. That's a technical case. But thank you so much. I think that's been a really, really rich conversation. If we always end any episode with a question of, if there is a bit of advice that you would give other advisors listening to this, what would it be?
I think stay true to yourself. Make sure that you're not just chasing a sale. Make sure that you're doing it for the right people at the right time. It's such the implications of getting it wrong can be significant, and the choice of products that we have, the features that are available, means that if the plan is right for a client, then there'll be a best fit solution. So if it's not right for the client, tell them. I think some of our happiest clients are ones that we've not done it for, because they know absolutely that they got the right advice, because we didn't sell them anything. We did, we went in there and we came away and we earned no money. They didn't do anything, but we've given them the path of achieving what they want to do. So it's about stay true to yourself, be honest, be real, sit with the clients, understand their circumstances, use outside support, as we've been talking about, other specialists, and make sure that it's just for the right people at the right time. We don't want you know, the equity release scandal in 2025 or 2026. You know, it's a product that should be around forever. You know, it's a product that I should be taking out when I'm grey and wrinkly.
Oh, thank you. I completely agree. Thank you.
Superb.
Yeah.